Question 1. An investment advisor representative, IAR, is primarily responsible for managing an investment advisory firm's general ledger, preparing financial statements, and ensuring compliance with state audit requirements. Under the Uniform Securities Act, does this individual need to register as an IAR? A. Yes, because managing financial statements is a core advisory function. B. Yes, because they are involved in the firm's overall operations. C. No, because their primary duties are administrative and accounting related, not advisory. D. No, unless they directly solicit clients for investment advisory services. Answer: C. No, because their primary duties are administrative and accounting related, not advisory. An individual must register as an investment advisor representative, IAR, if they provide investment advice, manage client accounts, solicit advisory clients, or supervise other IARs. In this scenario, the individual's duties are primarily administrative and accounting focused, such as managing the general ledger and preparing financial statements, which do not involve providing investment advice or managing client assets. Therefore, this role does not typically require IAR registration under the Uniform Securities Act, as it falls outside the definition of an IAR. Remember that registration is tied to performing advisory functions, not just being an employee of an advisory firm. Question 2. An investment advisor, IA, manages discretionary accounts for several high-net-worth clients. One client frequently calls the IA to discuss market trends and potential adjustments to their portfolio, even though the IA has full discretion. The IA documents these conversations thoroughly. What type of communication is this considered? A. An unsolicited order, requiring a written confirmation. B. A directive altering the discretionary authority. C. Informal communication, not requiring specific action beyond documentation. D. Client oversight of the discretionary relationship. Answer: D. Client oversight of the discretionary relationship. Even when an investment advisor has full discretionary authority, clients retain the right to oversee and inquire about their accounts. These discussions, while not directives that alter the discretionary authority, demonstrate the client's engagement and oversight of how their investments are being managed. The IA's thorough documentation is good practice, demonstrating diligence and providing a record of client interactions, which is crucial for compliance. It's important to differentiate between a client's general inquiries and specific instructions that would supersede or modify discretionary power. Question 3. Under the Uniform Securities Act, which of the following would not be considered a security? A. A limited partnership interest in a real estate development. B. A collateral trust certificate representing an interest in a diversified bond portfolio. C. An endowment policy purchased from a life insurance company. D. A certificate of interest in a profit-sharing agreement. Answer: C. An endowment policy purchased from a life insurance company. The Uniform Securities Act provides a broad definition of a security, encompassing many types of investment contracts where an investor expects profits from the efforts of others. However, certain instruments, particularly traditional insurance products like endowment policies, whole life policies, and term life policies, are specifically excluded from the definition of a security. These products are primarily designed for insurance protection or guaranteed benefits, not as investment vehicles whose value fluctuates with market forces and managerial effort in the same way as typical securities. Keep in mind that variable life insurance and variable annuities are considered securities because their value is tied to an underlying separate account. Question 4. An investment advisor, IA, has decided to switch all clients' cash balances from a money market mutual fund to a new proprietary money market fund managed by an affiliate of the IA. The new fund offers a slightly lower expense ratio but has a more restrictive redemption policy. Which ethical duty is most relevant to the IA's decision in this scenario? A. Duty of loyalty. B. Duty of best execution. C. Duty to disclose all material facts. D. Duty of care. Answer: A. Duty of loyalty. The duty of loyalty requires an investment advisor to put the client's interests before their own and to avoid conflicts of interest or, if unavoidable, to disclose them fully. In this scenario, switching clients to a proprietary fund, even with a slightly lower expense ratio, raises a conflict of interest because the IA or its affiliate stands to benefit from the increased assets under management in their own fund. While disclosure is important, related to the duty to disclose all material facts, the fundamental ethical principle at play here is ensuring that the advisor's actions are purely in the client's best interest, uncompromised by the advisor's potential gain. Always prioritize the client's benefit above any benefit to the firm. Question 5. An investment advisor, IA, has determined that a client, who is 80 years old and retired, has an investment objective of aggressive growth with a significant portion of their portfolio in highly speculative small-cap stocks. The client signed all disclosure documents acknowledging the risks. Which of the following describes the most immediate concern for the IA? A. The client's lack of diversification. B. The potential for churning in the account. C. The suitability of the recommendations for the client's age and circumstances. D. The impact of inflation on the client's fixed income. Answer: C. The suitability of the recommendations for the client's age and circumstances. While a client may sign disclosure documents, an investment advisor has an ongoing ethical and regulatory responsibility to ensure that recommendations are suitable for the client's investment objectives, financial situation, and risk tolerance. An 80-year-old retired individual with an aggressive growth objective and a portfolio heavily concentrated in speculative small-cap stocks raises significant suitability concerns, as such a strategy is typically inappropriate for someone in their life stage who likely needs capital preservation and income. The IA must prioritize what is truly suitable for the client, not just what the client says they want or signs off on, especially when it appears inconsistent with their circumstances. Question 6. A trust established for a minor is considering investing in a municipal bond. The minor's parent is the trustee. Which of the following characteristics of the municipal bond would be most attractive, given the minor's potential future tax situation? A. Its liquidity and call features. B. Its tax-exempt interest income. C. Its long maturity and high coupon rate. D. Its general obligation backing. Answer: B. Its tax-exempt interest income. Municipal bonds offer interest income that is typically exempt from federal income tax, and often from state and local taxes if the bond is issued within the investor's state of residence. For a minor, whose future income from the trust might be substantial and therefore subject to higher tax brackets upon reaching adulthood, this tax exemption provides a significant benefit by allowing earnings to grow tax-free. While other features like liquidity or maturity are relevant, the primary advantage of municipal bonds for a high-income, tax-sensitive individual or trust is their tax-exempt status. This tax advantage can greatly enhance net returns over time. Question 7. An investment advisor recommends a safe investment product to a client, stating it has absolutely no risk of principal loss. This statement is A. Permissible, if the product is backed by the U.S. government. B. Permissible, if the product is a money market fund. C. A fraudulent and prohibited practice. D. Acceptable, if the client is sophisticated and understands the nuance. Answer: C. A fraudulent and prohibited practice. No investment product, even those considered extremely low risk, can genuinely offer absolutely no risk of principal loss, because all investments carry some degree of risk, including inflation risk, interest rate risk, or even the remote possibility of issuer default. Making such an unqualified guarantee is a misrepresentation and constitutes a fraudulent and prohibited practice under securities laws, as it misleads investors about fundamental investment risks. Investment advisors must always be truthful and balanced in their representations, clearly disclosing risks alongside potential returns. Question 8. A client has instructed their investment advisor to purchase 100 shares of XYZ stock at a specific price, but only if the stock falls to that level. This type of order is known as A. Market order. B. Limit order. C. Stop order. D. Stop limit order. Answer: B. Limit order. A limit order is an instruction to buy or sell a security at a specific price or better. In this case, the client wants to buy XYZ stock at a specific price, but only if the stock falls to that level, which means they are setting a maximum price they are willing to pay. This ensures execution at or below the desired price, but there is no guarantee of execution if the market price does not reach the specified limit. Think of a limit order as putting a limit on the price you are willing to accept. Question 9. An investment advisor is providing advice solely to insurance companies. Under the Investment Advisors Act of 1940, must this investment advisor register with the SEC? A. Yes, all investment advisors must register with the SEC. B. Yes, unless they fall under a specific de minimis exemption. C. No, because advising insurance companies is exempt from SEC registration. D. No, if their assets under management are below the SEC's registration threshold. Answer: C. No, because advising insurance companies is exempt from SEC registration. The Investment Advisors Act of 1940 provides several specific exemptions from registration with the SEC, one of which is for investment advisors whose only clients are insurance companies. This exemption is distinct from the de minimis exemption, which applies to state registration, or the AUM thresholds. This specific exemption recognizes that insurance companies are typically sophisticated institutional investors that do not require the same level of protection as retail clients. Therefore, an IA whose exclusive clientele consists of insurance companies does not need to register with the SEC. Question 10. Which of the following statements regarding the performance of a growth stock is generally true? A. Growth stocks typically have high dividend payouts. B. Growth stocks are usually purchased for their stable earnings and income generation. C. Growth stocks are often characterized by high P/E ratios and reinvested earnings. D. Growth stocks are less volatile than value stocks during market downturns. Answer: C. Growth stocks are often characterized by high P/E ratios and reinvested earnings. Growth stocks are shares of companies that are expected to grow at a faster rate than the overall market. These companies typically reinvest their earnings back into the business to fund expansion and research, rather than paying out high dividends, leading to high price-to-earnings (P/E) ratios because investors are willing to pay more for future growth potential. Investors purchase growth stocks for their capital appreciation potential, not for stable income or low volatility. Always remember that growth companies prioritize expansion over current income distribution. Question 11. An investment advisor representative, IAR, moves from a state where they were registered to a new state to continue their practice, and both states require registration. Which of the following is the most accurate statement regarding the IAR's registration obligations? A. The IAR must re-register in the new state and notify the administrator in the old state. B. The IAR's registration automatically transfers to the new state. C. The IAR must register in the new state within 60 days of establishing residency. D. The IAR only needs to notify the administrator of the change of address. Answer: A. The IAR must re-register in the new state and notify the administrator in the old state. When an IAR changes states, they generally must register in the new state where they plan to conduct business, assuming that state requires IAR registration. Additionally, they must notify the administrator in the state they are leaving about the termination of their registration there. Registration is jurisdiction-specific, meaning it does not automatically transfer between states. Think of it like getting a new driver's license when you move to a new state. You generally need to apply for a new one and inform your previous state. Question 12. A client has invested in an income-producing limited partnership. Which of the following tax treatments applies to the income and losses generated by this investment? A. They are considered portfolio income and losses. B. They are considered active income and losses. C. They are considered passive income and losses. D. They are considered capital gains and losses. Answer: C. They are considered passive income and losses. Income and losses from limited partnerships are generally considered passive because the limited partners are not actively involved in the management or operations of the business. Passive losses can typically only be offset against passive income, not against active income, like wages, or portfolio income, like dividends or interest. This classification is important for tax purposes, as it dictates how these gains and losses can be used to reduce taxable income. Always remember that limited partners are generally passive investors. Question 13. An investment advisor, IA, has determined that a new client's primary objective is capital preservation and liquidity, but the client expresses interest in a speculative penny stock offering from a recent unsolicited email. The IA's most appropriate action is to A. Purchase a small amount of the penny stock to satisfy the client's interest while adhering to suitability. B. Purchase a diversified portfolio of blue-chip stocks to ensure capital preservation. C. Fully explain the significant risks of penny stocks and document the client's decision not to pursue it. D. Advise the client that the IA does not trade penny stocks and refuse the request. Answer: C. Fully explain the significant risks of penny stocks and document the client's decision not to pursue it. An investment advisor has a fiduciary duty to act in the client's best interest, which includes making suitable recommendations and educating clients about risks. If a client with a capital preservation objective expresses interest in a highly speculative investment like a penny stock, the IA's responsibility is not to simply refuse or partially fulfill the request but to thoroughly explain why it is unsuitable given their stated objectives and the significant risks involved. Documenting this conversation and the client's subsequent decision is critical for compliance and to demonstrate the IA fulfilled their duty of care. Question 14. Under the Uniform Securities Act, which of the following actions by an investment advisor would generally be considered a prohibited practice? A. Exercising discretion in a client's account without written authorization within 10 days of the first discretionary transaction. B. Charging a performance-based fee to a client with assets under management below $1.5 million. C. Delivering a brochure, Form ADV Part 2A and 2B, to a client at the time of entering into an advisory contract. D. Recommending a diversified portfolio of exchange-traded funds, ETFs, to a client. Answer: B. Charging a performance-based fee to a client with assets under management below $1.5 million. Performance-based fees, also known as fulcrum fees or incentive fees, are generally prohibited under both state and federal law for most clients due to the inherent conflict of interest they create, as they might incentivize an advisor to take on excessive risk. There are exceptions for certain qualified clients, such as those with at least $1.1 million, or as adjusted by inflation, currently $1.5 million, in assets under management with the advisor or a net worth exceeding $2.2 million, currently $2.2 million. Therefore, charging such a fee to a client below this threshold would typically be a prohibited practice. Question 15. A private fund manager, who is relying on the private fund advisor exemption from SEC registration, manages a fund with total assets under management, AUM, of $120 million. Which regulatory body would most likely have jurisdiction over this advisor? A. The SEC, because their AUM exceeds $100 million. B. FINRA, due to the nature of fund management. C. State securities administrators, as they are exempt from SEC registration. D. No regulatory body, as they are fully exempt. Answer: C. State securities administrators, as they are exempt from SEC registration. The Dodd-Frank Act introduced the private fund advisor exemption, which generally exempts advisors solely to private funds from SEC registration if they manage less than $150 million in assets. While exempt from SEC registration, these advisors are typically required to register with the state securities administrators where they have a place of business and/or clients, unless a specific state exemption applies. Therefore, for a private fund manager with $120 million in AUM, state regulation would generally apply, not SEC or FINRA. Question 16. A client asks their investment advisor representative, IAR, for tax advice regarding the sale of a significant stock position. The IAR, who is not a licensed tax professional, offers specific recommendations on how to minimize capital gains taxes. This action by the IAR is A. Permissible, as long as the IAR notes that they are not a tax professional. B. A violation of ethical duties and professional boundaries. C. Acceptable, if the client has signed a waiver releasing the IAR from liability. D. Permissible, as general tax implications are part of financial planning. Answer: B. A violation of ethical duties and professional boundaries. Investment advisor representatives are generally not qualified to provide specific tax advice unless they are also licensed as tax professionals, example CPAs or tax attorneys. Providing specific recommendations on how to minimize capital gains taxes crosses the line from general financial planning discussions into specific tax advice, which is outside the scope of an IAR's professional competence. It is crucial for IARs to understand the limits of their expertise and advise clients to consult with qualified tax professionals for specific tax planning. Question 17. Which of the following is considered a primary risk associated with investing in a callable bond? A. Interest rate risk. B. Inflation risk. C. Reinvestment risk. D. Legislative risk. Answer: C. Reinvestment risk. A callable bond gives the issuer the right to redeem the bond before its maturity date, typically when interest rates decline. If a bond is called, the investor receives their principal back prematurely. This creates reinvestment risk because the investor is then forced to reinvest that principal at potentially lower prevailing interest rates, making it difficult to achieve the same yield they were originally earning. While interest rate risk is a general risk for all bonds, reinvestment risk specifically arises from the call feature. Question 18. An investment advisor has custody of client funds and securities. Under the Investment Advisors Act of 1940, which of the following is not a requirement for advisors with custody? A. Sending account statements directly to clients at least quarterly. B. Arranging for an annual surprise examination by an independent public accountant. C. Maintaining client funds and securities with a qualified custodian. D. Filing Form ADVE with the SEC annually. Answer: D. Filing Form ADVE with the SEC annually. Investment advisors with custody of client assets must adhere to strict rules to protect those assets. These rules include maintaining client funds and securities with a qualified custodian, arranging for an annual surprise examination by an independent public accountant, and sending account statements directly to clients at least quarterly. Form ADVE is filed by the independent public accountant after they complete the surprise examination, not by the advisor annually. The advisor's responsibility is to ensure the examination happens and the accountant files the form. Question 19. An investment advisor, IA, has created a complex financial model that projects market returns based on proprietary algorithms. The IA plans to use these projections to solicit new clients. Under the Uniform Securities Act, what is the primary concern regarding these projections? A. They must be approved by the state administrator before use. B. They are considered prohibited, hypothetical illustrations. C. They could be viewed as misleading if not properly qualified and explained. D. They are only permissible if based on historical data. Answer: C. they could be viewed as misleading if not properly qualified and explained. Investment advisors are prohibited from making misleading statements or using deceptive practices. While projections based on complex models are not inherently prohibited, they carry a high risk of being misleading if presented without clear disclaimers, explanations of assumptions, and caveats about their hypothetical nature. Projections are inherently speculative and cannot guarantee future performance. The primary concern is always transparency and avoiding exaggeration or misrepresentation, ensuring clients understand that such projections are not guarantees. Question 20. A client invested in a bond with a coupon rate of 5% and a par value of $1,000. If the bond is currently trading at 95, what is its current yield? A. 5%. B. 5.26%. C. 4.75%. D. 5.5%. Answer: B. 5.26%. Current yield is calculated by dividing the annual interest payment by the bond's current market price. The annual interest payment is 5% of $1,000 par value, which is $50. The bond is trading at 95, meaning 95% of par, or $950. So, the current yield is $50, annual interest, divided by $950, current market price, which equals approximately 0.05263 or 5.26%. This metric helps investors understand the return on their investment based on the bond's present market value. Question 21. Which of the following best describes the prudent investor rule as it applies to fiduciaries? A. Fiduciaries must only invest in U.S. Treasury securities to ensure maximum safety. B. Fiduciaries must avoid all speculative investments, regardless of the client's risk tolerance. C. Fiduciaries must consider the portfolio as a whole, rather than individual investments, in relation to the trust's overall risk and return objectives. D. Fiduciaries are required to generate the highest possible returns for the beneficiary, even if it means taking on significant risk. Answer: C. Fiduciaries must consider the portfolio as a whole, rather than individual investments, in relation to the trust's overall risk and return objectives. The prudent investor rule, which has largely replaced the older, prudent man rule, emphasizes a modern portfolio theory approach. It dictates that a fiduciary's investment decisions should be evaluated in the context of the entire portfolio and its overall risk-return characteristics, rather than judging each individual investment in isolation. This allows for diversification and the inclusion of various asset classes to achieve the trust's specific objectives, even if some individual components might appear risky on their own. It focuses on the total portfolio's appropriate risk level and return expectations for the beneficiary. Question 22. A client experiences a significant loss in their portfolio, attributable to a major market downturn. The client claims the investment advisor, IA, is liable because the IA did not predict the downturn. Under what circumstances would the IA likely be held liable? A. If the IA failed to diversify the client's portfolio appropriately. B. If the IA did not guarantee specific returns. C. If the IA adequately disclosed all potential market risks. D. If the downturn was unforeseeable by any market expert. Answer: A. If the IA failed to diversify the client's portfolio appropriately. Investment advisors are not guarantors of investment performance and are not expected to predict market downturns. However, they are obligated to act in the client's best interest, which includes recommending a suitable and properly diversified portfolio given the client's objectives and risk tolerance. If the client's loss was due to a lack of diversification, meaning the portfolio was excessively concentrated and thus exposed to undue specific risk that could have been mitigated, the IA could be held liable for failing to uphold their duty of care. Question 23. An investment advisor representative, IAR, is discussing a mutual fund with a prospective client. The IAR states that the fund has consistently outperformed its benchmark over the past 10 years, showing a significant average annual return. What additional disclosure is most important for the IAR to make regarding this performance data? A. That past performance is no guarantee of future results. B. That the fund's expense ratio is competitive. C. That the fund uses an active management strategy. D. That the fund is highly diversified. Answer: A. That past performance is no guarantee of future results. When presenting any historical performance data, especially for mutual funds or other investment vehicles, investment advisors are ethically and legally required to clearly state that past performance is no guarantee of future results. This crucial disclaimer prevents investors from being misled into believing that previous success automatically translates into future returns. This phrase is a fundamental aspect of fair and balanced communication in the securities industry, ensuring transparency about the inherent risks of investing. Question 24. A corporation offers its employees a retirement plan where the employer contributes a fixed percentage of an employee's salary each year, and the employee bears the investment risk. This is an example of A. Defined benefit plan. B. Defined contribution plan. C. Non-qualified deferred compensation plan. D. Cash balance plan. Answer: B. Defined contribution plan. In a defined contribution plan, such as a 401k or 403b, the employer, and often the employee, contributes a specified amount or percentage to the employee's individual account. The ultimate retirement benefit depends entirely on the performance of the investments within that account, meaning the employee bears the investment risk. In contrast, a defined benefit plan promises a specific payout at retirement, with the employer bearing the investment risk. The key distinguishing factor is who bears the investment risk. Question 25. An investment advisor, IA, provides comprehensive financial planning services, including estate planning recommendations. If the IA recommends a specific trust structure to a client, which professional should the client ultimately consult before implementing the trust? A. A certified public accountant, CPA. B. A real estate attorney. C. An estate planning attorney. D. A trust company representative. Answer: C. An estate planning attorney. While an investment advisor can provide general financial planning and recommend strategies, they are not qualified to provide legal advice or draft legal documents like trust agreements. Estate planning involves complex legal considerations, and the creation and implementation of specific trust structures require the expertise of a licensed estate planning attorney. The IA's role is to identify needs and recommend strategies, but the client must always engage an appropriate legal professional for the execution of legal documents.